mortgage lending, there are four main components. One of those being under liquid assets actually goes on an application, and a loan officer and an underwriter are going to be looking to verify those assets via paper documentation, such as bank statements. And there's right ways to have assets, and then there's kind of wrong ways to have assets. So I thought it was important to talk about those because those actually carry through to something called cash to close. And when you're buying a home, at the bottom line is you're going to have to bring in some funds to close, which typically consists of down payment and your closing costs. Now, when at the beginning, when we've taken an application, we're going to ask you for all your bank statements, actually the last 2 months of checking savings. Retirement accounts fall under that, such as 401k, IRAs, brokerage accounts with securities. Those are all considered liquid assets. Now, within the liquid assets category, there's acceptable liquid assets and unacceptable. Most funds are acceptable, but they have to be what we call seasoned verified funds. That means when we ask for 2 months bank statements, the underwriter is going to look to see that there's not any large deposits that can't be explained. Like if you have your pay stub being direct deposited into your bank statement, that's explainable, and the underwriter can see that right away, and there's no questions about that. But if you have a large deposit, which is deemed 50% or more of your gross income, so let's say hypothetically you're grossing $10,000 a month, and there's a $6,000 payment, or maybe two payments of $3,000 each, and actually I should say deposits, not payments, that come into that account, and we can't verify where those funds came from, then the underwriter is going to look at that and question it, and then we've got to prove that it came from an acceptable source. An acceptable source is maybe you sold a car. Now, you'd have to paper trail that properly, such as you'd have to have the bill of sale from the sale of the property, show that you owned it. It gets a little bit tedious, to be honest with you, in regards to paper trailing assets. Or maybe it came from another account. Maybe you had a large deposit coming from a Schwab account, for example. Then we'd get the 2 months Schwab account showing that you had seasoned verified funds in that as well. So they're just making sure that there's no large deposit. Where it becomes problematic is when we can't paper trail it, such as some people keep cash on hand. They might have $5,000, $10,000 at their home, and then they go ahead and deposit that into an account. We cannot use those funds for what we call cash to close. So when an underwriter got your file, they would back that out of the numbers, and you could not use those funds to purchase a home. So it's important that not only an underwriter, but more importantly, your loan officer looks at the bank statements, make sure that there are no large deposits that are coming into the account. So I would recommend to you as a buyer, if you've got some cash on hand, maybe sooner rather than later, deposit that into an account so it gets seasoned. And usually once it's in an account for about 90 days, we only require 2 months bank statements, but about 90 days, then it would be seasoned in that account and no questions would be asked, okay? The other part of the cash to close is some products, some guidelines required to have reserves. So it's not only your down payment, it would be enough money to cover your closing costs. But some of the, especially what we call the jumbo lenders, require 6 months, 12 months, 18 months reserves, which is essentially a reserve is 1 month of a mortgage and housing payment, I should say, which consists of principal, interest, taxes, and insurance. So, if your payment was $1,000 a month and you had to have $6,000 then if there was 6 months reserves post-closing. Now, a lot of the loans in the United States, such as Fannie Mae, Freddie Mac, FHA, VA, they don't necessarily require you to have reserves post-closing. So it's not money that you have to give to anybody or have in an account. The underwriter is going to look just to make sure that if something happened, you've got 6 months reserves post-closing, and it could help you make your housing payment if there was job loss or disability, things along that line. So going back to the cash to close, So once you're in contract, you're going to have to come up with typically an earnest money deposit. That could be anywhere from 1 to 3% of the purchase price. That will go toward your down payment as well. So as the file moves along, and actually when you go into contract, you get an LE, which is a loan estimate, and that'll give you an idea of the numbers in regards to how much your closing costs are, how much the down payment is, and what we call again cash to close. Now, out of that, typically we'll back out the earnest money deposit. So if you had given earnest money deposit of $10,000, $20,000 to the escrow company, then that's clearly not money you would have to bring into the closing. Another form of acceptable down payment and/or cash to close, which would cover the closing costs, is a gift. It's actually quite common. So a relative of yours can absolutely gift you funds. I typically say the easiest way to do that is let them hold on to the funds unless they've already given it to you. But the easiest way is to let them hold on to the funds, and we get what is called a gift letter. Most lenders have a boilerplate form that can be completed by the giftor. Some products require a bank statement to be viewed, and then some don't. Typically, what I suggest the best way to do is the gift letter. We get the bank statement if needed, and if we don't need it, then we don't. And then have the gifter just wire those funds into escrow once you're in contract, and we know exactly how much the gift is going to be. And that makes things a lot simpler. If you deposit it into your account, there is the paper trailing of funds, which is not insurmountable, and it can be done. It's just a little tedious on you, the buyer. Basically it's getting account activities from the date of the last bank statement to when the deposit was made. So it gets just a little bit, again, tedious, not insurmountable. If you're tech friendly, you can certainly walk through it. It's not an issue, but I just find it easier if you just have the gifter wire those funds into escrow. It gets verified that way, and you don't have to get into the paper trail situation. Regarding your assets, I would recommend, as you're looking to buy a home, you haven't gone into contract yet, try to keep things as stable as possible. We sometimes see people who have multiple accounts and they move money from one account to another, and that's where things can get, as I mentioned before, a little tedious. Sometimes we would have to paper trail those funds from one account to another. It depends on how much and or how clear those transfers were from one account to the other. So I would recommend, having your payroll go into an account. If it can just drop into a savings account, just start saving it there, keep it there. Try not to move those funds around very much. That will make your life a lot simpler once you go into contract. If you found this information useful, if you wouldn't mind liking, subscribing on my channel, and feel free to reach out with any questions. Be happy to help in any way I can.